Why stability started creating risk. For years, the system believed it had finally solved its most dangerous problem. Markets were calm, failures were rare, and confidence felt almost permanent. But beneath that calm surface, stability itself was quietly becoming a source of danger. To understand why modern banking now struggles with risks that seem to appear from nowhere, we need to return to the moment when preventing crises became more important than understanding them. Because the same logic that once reduced volatility is now reshaping how instability forms today. In the aftermath of repeated financial disruptions, stability became the ultimate objective. Policymakers focused on smoothing cycles. Banks focused on reducing visible volatility. Markets learned to interpret calm as health. This mindset transformed how success was measured. Fewer failures meant progress. Lower volatility meant safety. Predictability became the primary signal of strength. As safeguards expanded, fear retreated. Deposit insurance reassured the public. Liquidity facilities reassured markets. Capital buffers reassured regulators. Each layer reduced the likelihood of immediate collapse. But each layer also softened the consequences of risk-taking. Behavior began adapting to protection rather than restraint. Banks learned that instability would be managed. Shocks would be absorbed. Disruptions would trigger response. Over time, this expectation became embedded in decision-making. Risk assessment changed subtly. The question was no longer how bad outcomes could become, but how quickly stability mechanisms would activate. Timing replaced magnitude as the central concern. As a result, risk did not disappear. It accumulated quietly. Leverage increased gradually. Complexity expanded without resistance. Stability masked these changes. Calm markets discouraged scrutiny. Low volatility muted warning signals. The absence of failure felt like validation, but stability also altered incentives. Caution offered diminishing returns. Restraint appeared unnecessary. Those who pushed boundaries were rewarded. This created an asymmetry. Upside remained private. Downside became shared. Risk-taking felt rational inside a protected environment. Over time, stability stopped reflecting resilience. It began reflecting intervention. Markets functioned smoothly, but only because they expected support. This was a shift nobody acknowledged. Stability was no longer a result of prudent behavior. It was a condition being actively maintained. And once stability must be maintained, it begins shaping behavior in ways that quietly generate risk. As stability became something delivered rather than earned, the system slowly recalibrated around that promise. What once restrained behavior through uncertainty was replaced by confidence in response. Risk did not feel dangerous anymore. It felt manageable. Banks adjusted their strategies accordingly. Balance sheets stretched gradually. Short-term funding supported longer-term commitments. Margins were optimized under the assumption that volatility would remain contained. This did not feel reckless. It felt rational. Models incorporated historical calm. Stress scenarios assumed intervention. Extreme outcomes were discounted as unlikely. Markets reinforced this logic. Low volatility rewarded leverage. Predictable policy responses reduced fear. Price signals softened. Even as exposure grew, over time, the system lost its sensitivity. Small warnings no longer triggered adjustment. Minor disruptions were absorbed and forgotten. Each successful rescue validated the approach. But protection changes behavior. When consequences are delayed, risk accumulates. When losses are socialized, incentives shift. Caution fades quietly. The structure of banking reflected this change. Assets became more correlated. Strategies converged. Diversity declined in favor of efficiency. Stability encouraged uniformity. Uniformity reduced resilience. But the trade-off remained invisible during calm periods. Everything still worked. Liquidity appeared abundant. Markets reopened quickly after stress. Confidence returned faster each time. The system seemed to heal itself. In reality, it was becoming dependent on reassurance, dependent on coordination, dependent on belief being preserved. Risk was no longer priced by fear. It was priced by expectation of support. This distorted judgment across institutions. Everyone assumed the same backstop. The early tension formed here. Stability had stopped acting as a SI. The conflict surfaced when the system finally encountered a shock that stability mechanisms could not immediately absorb. Not because the shock was unprecedented, but because the structure had become too sensitive to disruption. Small movements produced outsized reactions. As stress appeared, institutions responded predictably. They sought liquidity. They reduced exposure. They waited for guidance. Behavior converged instantly. What was meant to stabilize instead accelerated pressure. Selling increased correlations. Hedging amplified volatility. Protective actions reinforced each other. Stability had trained banks to move together. Independence faded. Diversity disappeared. Reaction became synchronized. This synchronization exposed a hidden weakness. When everyone relies on the same safeguards, those safeguards become bottlenecks. Support could not reach everyone at once. Liquidity, once abundant, became uneven. Markets hesitated. Confidence wavered. And without confidence, stability unraveled quickly. Policymakers intervened as expected. Facilities expanded. Assurances multiplied. Calm returned. But the pattern was clear. Stability no longer reduced risk. It concentrated it. Each rescue increased dependency. Each intervention raised the cost of inaction. The system could survive stress, but only through escalation. Support had to arrive faster and larger each time. The margin for error narrowed. This was the core conflict. A system designed to suppress volatility had become fragile to change. Adjustment required force rather than flow. Banks recognized the dilemma. They were safer inside the system, but more vulnerable if it failed. Risk was no longer individual. It was structural. Stability had succeeded too well. It removed the friction that once limited excess. And without friction, pressure had nowhere to go but outward. This tension could not be resolved quietly. It demanded a reckoning, one that would redefine what stability actually meant. The climax arrived not as collapse, but as understanding spreading through the system. Stability had not eliminated danger. It had delayed it, compressed it, and redirected it into fewer, more fragile channels. By removing friction, the system removed its natural warning signs. Volatility no longer signaled excess. Losses no longer enforced restraint. Calm stopped reflecting health. Stability had become performative, maintained through reassurance, preserved through intervention, defended through coordination. And the more stability was defended, the more behavior adapted to expect it. Risk-taking felt safe because response felt guaranteed. Exposure felt manageable because consequences felt distant. Correction felt unnecessary because support felt inevitable. This inverted the logic of resilience. Instead of absorbing shock gradually, the system stored pressure. Instead of adjusting early, it waited. When adjustment finally arrived, it did not arrive gently. It arrived all at once, across markets, across institutions, across expectations. The system could still survive these moments, but survival now required escalation, faster action, larger support, greater certainty. Stability no longer reduced the need for intervention. It increased it. Each calm period raised the stakes of the next disruption. Each rescue narrowed the path for future response. The resolution is not about abandoning stability. It remains essential. But stability cannot be treated as an endpoint. It must be responsive, not rigid. Adaptive, not absolute. A system that never feels stress, forgets how to manage it. A system that never corrects early, corrects violently later. American banking now operates inside this paradox. Stable yet sensitive. Calm yet dependent. Protected yet exposed. Stability did not fail. It simply went too far. Why?